SV Union High School and Junior College, Pune. Economics, Standard 12. Presented by Dr. Inderjit Kaur Ahluwalia. Chapter 8, Public Finance in India, Part 3. Structure of public finance. In our last video, we have seen the structure of public finance at a glance. The first one is public expenditure. Second, public revenue. Third, public debt. Fourth, fiscal policy. And fifth, financial administration. Last time we have studied the meaning of public expenditure and the reasons for growth in public expenditure in India. Today, in this video, let us study about public revenue. Public revenue means the aggregate collection of income with the government through various sources. Public revenue holds the permanent position in the study of public finance, which is part of study of economics. Thus, the necessity of public revenue arises due to public expenditure. Sources of public revenue. The main sources of public revenue are as follows. First, taxes. And second, non-tax revenue. What are taxes? According to Professor Tausig, the essence of a tax, as distinguished from other charges by government, is the absence of a direct quid pro quo between the taxpayer and the public authority. According to Professor Seligman, a tax is a compulsory contribution from the person to the government without reference to special benefits conferred. Characteristics. A tax possesses following essential characteristics. First, it is a compulsory contribution to the government, and every citizen of the country is legally bound to pay the tax imposed upon him. It is a major source of revenue to the government. If any person does not pay a tax, he can be punished by the government. Second characteristic is tax is paid by a taxpayer to enable government to incur expenses in the common interests of the society. The third characteristic is the payment of a tax by a person does not entitle him to receive any direct and proportionate benefits or services from the government in return for the tax. And fourth characteristic is tax is imposed on income, property or commodities and services. Types of taxes. There are two main types of taxes. They are direct tax and indirect tax. Let us study both of these separately in detail. Direct tax. It is paid by the taxpayer on his income and property. The burden of tax is borne by the person on whom it is levied. As he cannot transfer the burden of the tax to others, impact and incidence of direct tax falls on the same person. For example, personal income tax, wealth tax, etc. Direct taxes are further classified into three categories depending upon the rate of tax. These are proportionate tax, progressive tax and regressive tax. Second is indirect tax. It is levied on goods or services. It is paid at the time of production or sale and purchase of a commodity or a service. The burden of an indirect tax can be shifted by the taxpayer, that is producers, to other person or persons. Hence, impact and incidence of tax are on different heads. For example, newly implemented goods and services tax, that is commonly called as GST in India, has replaced almost all indirect taxes, custom duty. Thus, we have studied about the first main type of tax, which is known as tax. The non-tax revenue source will be discussed in the next video.